Property values could go nowhere in the next 10 years. And that's the headlines across Australia right now. But is it really true? Hi, my name's Brendan Kelly and I'm joined by Simon Buckingham today. Welcome, Simon.
Hey, Brendan, good to be here.
What have you seen in the headlines lately?
Headlines like property market plummets as pricing downturn spreads, housing market downturn spreads across country, a decade or so of real house prices ranging sideways, the new housing reality, and talking about the end of the 30-year super cycle. So these are all great for clickbait and for getting ratings and readings. And frankly, we played on some of this in our headline for today's session. How much truth is there in these headlines? Is this just drama for the sake of drama and clicks? Is there a 30-year property super cycle that's really ending? And what does that mean for property values? Does that actually mean property values could go nowhere for the next 10 years? Now, in doing this, we're not going to pretend that there's no downturn at the moment, that the downturn that we're seeing in the market isn't real. But I think we really have to separate today, Brendan, the idea of a falling national median house price from the claim that every single property market everywhere has suddenly stopped growing. And look at what the data really says. So let's dive into that. What's the data, the most recent data showing?
So we're now early August, and at the end of every month, Cotality comes out with an updated series of numbers around what's occurred in the last 30 days and then the last quarter last year, etc. On the basis of that, national values have fallen 0.7% in the month of July. Now you extrapolate that out, that's around 12 sevens or 84. So you're at about an 8% fall nationally as a rate of decline right now. It's not that it's fallen 8%, but as a rate of decline, the speed at which the market's moving down is around 8% if you just extrapolate by multiplying by 12. The decline, now, it's led by Sydney and Melbourne. Sydney has got the steepest rate of decline right now, followed by Melbourne. Brisbane and Adelaide have now recorded consecutive months of falls. Brisbane and Adelaide are just 2 months negative. Perth was slightly positive in July. Darwin is still rising. But nationally, prices are below their March peaks. Now, again, March peak, if you look at the national prices, yes. But as you know, there's not one market. The national market is a representation of, if you put every sale in the country ranging from lowest to highest and you pick the middle number, that's the median. But it really doesn't tell you very much. And if you go into states, the stories are very, very different. Before we get into that sort of detail, the question really becomes, and the thing that's challenging most, this 30-year super cycle thing, where has that come from? My read is that that's about the period of time that we've had negative gearing and capital gains tax influences since around the late 90s. So that's what we've called a super cycle. I think that's the correlation, and the budget has just ended the 30-year super cycle. That's my only point of reference that I've got on that, because there's nothing in any of the data that I've seen that represents anything close to a 30-year super cycle on repeat. The term cycle meaning something that repeats. It just doesn't exist. Simon.
The idea, I think, behind this super cycle concept is that over the past 30 years, property prices have supposedly benefited from a number of, I guess you could call them, structural tailwinds. So we've had mortgage rates trending lower over that period of time, although the reality, as we know, is they've gone up and down over that period of time. You've had some easier access to credit, for sure, but there have been periods where that's tightened. You've had the rise of two-income households, and I think that is something that has changed over the past few decades. More people buy houses together with dual incomes than single incomes. We have had strong population growth over that period of time. And of course, there have been some favorable investor tax settings during that period. And as we know, and as we're constantly told by the media, we have a housing crisis, so we've got insufficient housing supply going on. So all these things combined supposedly have created this 30-year super cycle. But when you hear that, you think, oh, well, property prices have just consistently gone up over 30 years. Brendan, can you maybe share some data and let's take a glance at this and see what it actually seems to show us, yeah?
Here's a graph from 1881 through to 2021. And this is an illustration of real median house price. So you've removed the influence of inflation. From 81 through to 46, prices hovered around the same. I don't think there was a super cycle there in real terms. Post-war, well, okay, that's always wonderful. There's a lot of celebration and a massive baby boom going on post-war. You could probably say from 51 through to 71, I can see 20 years of regular growth, but we had to have a couple of world wars to substantiate that. I don't necessarily want to go through that again as a trigger. We've had from there a flattish sort of market, a couple of recessions, few changes. We deregulated the dollar. We had a bit of a credit boom when we deregulated the dollar. We plateaued in the recession that we had to have for a while. And after that, we took off again. And this is around mid-late 90s. And I think this is representing the concept of what the super cycle may be. But even then, you've had periods of flat with the GFC, and obviously you've had a COVID scenario. So it's a fascinating thing to call it a super cycle. And Simon mentioned some of the parameters around why they might call it a super cycle. You've got inflation. So cash rate, yep, there was a trend with the cash rate coming down, which supported a bit of growth. That took a few years to put into play, but with lower interest rates, people said that's wonderful. It went down. It's obviously come back up. Inflation was high. It's come back down. Again, these are real dollars. And mortgage interest rates, which were high, have now come back. So we got a scenario where there's a variety of different movements across the board. But if you're talking macro terms, you can see some broader trends. Again, I go into the 30-year super cycle. We had a lift from the mid-90s into maybe the early 2000s. Again, you're talking 10, 15 years, perhaps. But it's not a cycle. It's not on repeat. So I can't see the super cycle. Yes, there might have been some lift. No problem. I get that. What this illustrates, though, I mean, while you're talking about the median price of every house in the country giving you this sort of real-term effect, if you break that down into smaller markets, such as by city, markets behave very, very differently. For example, let's say the 90s recession we had to have. Now, I appreciate this as history and it's not real terms now, but as an illustration of different market conditions and how they play out, it's not a bad model. So you've got a scenario here in Sydney where you've had it flat from the mid-90s. Simon, you've got a chart actually on Sydney.
So this will be familiar to our results mentoring program members as part of the materials that they've got access to. But this particular chart here that I'm showing is of the Sydney median house price from the late 80s to the 2020s. And what you can see here is, essentially over this 30-year super cycle period, you had two 10-year periods in Sydney where the Sydney median house price didn't beat inflation. Between 88 and 98, the average annual growth rate over that period of time worked out to be about 3%. Well, guess what inflation was running at on average over that period of time? 3%. So in inflation adjusted terms, if you're holding the median house in Sydney over that period of time for 10 years, your value didn't really beat inflation. It didn't go up faster than inflation. And is that a one-off? No. Coming back to this idea that these structural incentives for investors somehow triggered some sort of super cycle. Well, if you take between 2003 and 2013, CGT discounting in place, negative gearing benefits in place, you had prices in Sydney, the median price come down, go sideways, and only come back up at the very tail end of that 10-year period. Average rate of growth for another 10-year period, 3%. Average rate of inflation, 3%. No real growth. 20 years out of that 30-year block. How's that a super cycle? Now, it's not to say that you can't then have 10 years of little to no growth when we're looking at it at this higher level. And I want to dig into that a little bit more in a second, but it highlights that this drama in the headlines is really ignorant of the fact of what's in history. We have very short attention spans, very short memory spans these days. We get used to the idea of exceptionally high growth over the last 2, 3, 4, 5 years and think that that's somehow normal. And we lose sight of the fact that's not how the property market actually behaves over time, is it?
If we look at some flat times, you got Sydney flat while Brisbane is in growth. You've got Sydney in growth while Brisbane is flat. You've got Melbourne and Sydney doing similar things for a period. Sydney's in decline where Melbourne's in growth. It is just different markets behave differently at a city level.
Look at that most recent 10 to 12 years on the chart there. The difference between, say, Brisbane and Sydney and some of the other capitals. You had Brisbane go down and then just went sideways for, again, like 10 years.
In
As
real
some other
terms,
capitals
correct.
were rising.
Just
And
as it
so-
did from the 90s.
Yeah, correct. So did we have headlines at the time going, it's 10 years of no growth? No, people just ignored that and got on with stuff and just went back to their investing, whether it was in Brisbane, Sydney, or wherever.
I think which, and we'll probably get to this in a little more detail in a minute, but which goes to the main concept. Simon, did people go broke in property investing in Brisbane in that 10-year period? How did people make money in that time? And you just change your strategic approach. These are perfect times for value projects.
Why did anyone invest between 2010 and 2020 if they were living in Queensland? Why would they do that?
Yeah, and again, it's all about the approach, the strategy, the adoption of a particular way of investing. If you go for a 30-year model or the 30-year super cycle, you go for a 30-year model, sure, you will get periods of flat, you get periods of growth. People are going to continue to invest in property no matter what conditions they're in. The different strategies play out differently in different markets, and add value projects are a way to go, particularly in flat markets. So if it is, we are 10 years of flat going forward, then hey, what an opportunity to add value and sell and make a packet along the way. The more you know about markets, the more you know about how to add value and profit, the more money that's available to you. And it's so much easier to read a market in a flat market. When it's growing, there's a little less risk. When it's declining, there's a little more risk. Anyway, I digress. Moving on. Now, this is not inflation removed. These are the same median prices by city, but without removal of inflation. There has been in Sydney periods of flat. You've gone up for a boom, flat, up for a boom, flat. And then we've gone higgledy-piggledy all over the place, but we've got a bit of growth. So this is what's occurred since 21. You can see Brisbane, Perth and Adelaide have all exploded in value while Melbourne has stayed flat for about 5 years. So that's looking at it city by city and illustrating that cities themselves behave differently. If we have a look at different price points and broader locations, city versus region, house versus unit, how do they play out? And again, the markets behave different house versus unit as they do city versus city, as they do suburb versus suburb. And it is a vast array of different things that are going simultaneously within the broader market. The art is to pay attention to the details of where you're investing, what's happening in your market, and read the information that's occurring in your market.
Keep in mind that what people have experienced over the last 3 to 5 years is an unusually strong period of house price growth across many, not all, but many parts of the country. And that's not the normal behavior of the market. That is unusual. And we've got to distinguish that and this idea that prices might go sideways for 10 years, according to some of the headlines, from the idea that there'd be no price growth anywhere or that there'd be no individual suburbs that outperform, because those are really different positions, really different claims. And we have to be smarter as property investors than that. Yes, there's all the noise and it can be a little overwhelming at times. We've got to be smart and be able to see past that.
A slower national market is plausible, absolutely. But 10 years of no growth across 15,000 suburbs simultaneously is not a way to look at the market. The market does not behave that way. What does this mean for investors? What do people want to take on from this?
If the easy sort of broad-based growth that we've seen in many parts of the country is ending, then as smarter, more sophisticated investors, we need to be a bit more clever. You can't just go and buy, any old shit anywhere anymore and expect to profit from growth. Suburb selection really matters a lot more now. And we've got to be clever about which suburbs we pick and the type of assets in those suburbs that we are choosing and the strategies we're applying. So things like buying at the right price matters more. And guess what? We've got an emerging significant negotiating opportunity. And I want to give a shout out to Mark and Nicola, who are on the session today, who just negotiated a 17% discount off asking price on a property that they've just put under contract. So really exciting negotiating opportunities there. With capital growth, perhaps less certain in certain areas, cash flow comes to the fore. So your ability to generate cash flow, your ability to hold the property, your holding power, your borrowing capacity starts to matter more. And you need to be smart around that. But what we have to be very careful about is just blindly relying on the market to lift the value of our assets as a substitution for skill and knowledge and understanding of the market, because that's just introducing risk into our deals.
If broad growth becomes harder, skill becomes more valuable. How do you skill up? How do you improve your knowledge, get greater depth of experience, get a greater depth of understanding to be able to invest better, more wisely, to ensure profits in the projects you're looking to take on? The question isn't whether the Australian property market will grow, it's which markets are positioned to grow and whether you know how to identify them.
Just like previous periods in other markets around the country that have experienced times where values have gone sideways for a period of time or even drifted down, if you're smart to isolate the suburbs that are defying that trend, use the strategies that will actually profit despite that trend, then you stand to make a lot of wealth for yourself and your family in the years to come.
Thank you very much for joining us today. We'll see you next Thursday, same time. Take care, guys.